All we ever hear about energy on the news is the simplistic rhetoric of the green agenda. Oil bad, wind and solar good. But we are investors, so what we really care about is the money behind it. Is oil a good investment? Buying oil commodities won't destroy the world, but it could make you filthy rich.
Oil prices have collapsed in 2020 following the outbreak of the corona pandemic, down a mega 63% since the start of the year at the time of filming in April. This is the West Texas Intermediate Oil Price, a grade of crude oil used as a benchmark in oil pricing. Around $23 a barrel is incredibly cheap when we consider it was $135 in 2008, its historical high.
In this video, we're going to cover why oil prices are so low, the easy ways that you can invest in oil, and how I just invested in oil the money unshackled way. Layering in cash flow and diversification into this classic growth asset. Let's check it out.
Welcome to MoneyUnshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben. Tune in Mondays, Thursdays and Saturdays at 6 PM UK time. That's right, MU is now 3 days a week. If you like what we say, hit the like button and click subscribe.
Invest in oil while getting a freebie. Investment app Freetrade are giving a randomly chosen free share to each new customer who opens an account using the link on the offers page at MoneyUnshackled.com. It could be worth up to £200 and all you have to do is open an account and top up by £1. What are you waiting for?
Why oil prices are so low. Two things happened in early 2020 to push oil prices to record lows. First off, the oil wars, followed 2 weeks later by the coronavirus and subsequent lockdowns. The drop in demand from recession and lockdown would normally be enough to reduce oil prices, but the price was artificially lowered even further by a major player in the world oil economy. Saudi Arabia.
The Saudis decided that they didn't like the way Russia were looking at them at an oil conference in March 2020 and announced that they would flood the market with cheap oil, a form of mutually assured destruction for both economies. At time of filming, Trump had just announced an international deal to get oil prices back up, but the very next day they actually fell further.
Oil as an asset. Oil fits into the core of our investment portfolios. The core is reserved for cash flow generating assets like rental property, global dividend paying ETFs, and high interest peer-to-peer lending. And oil stocks are the biggest and most dependable dividend paying stocks out there.
Oil itself is a commodity and we hold these in the core of our portfolio to help us own inflation and own the world. We've previously mentioned that commodities like oil and gold might make up 5 to 10% of your portfolio.
Oil as a commodity is a growth asset, meaning it doesn't generate cash flows and you're investing in it in the hope that its price will go up. Whereas shares that go up and down in price still pay dividends. It's nice to get regular cash injections from your dependable shares, regardless of the ups and downs of the market. But your commodities do not pay you a cash tribute.
So by investing in oil commodities, we are banking on the oil price going up in the future. Now let us tell you 3 ways to invest in oil and which is best.
The different ways you can buy oil. Number 1, invest in oil directly with an ETC. The purest way to invest in oil, outside of actually buying a barrel and storing it in your garage, is by buying it through an ETC or exchange traded commodity. We decided this one was as good as any other, the Wisdom Tree WTI crude oil ETC, which has an ongoing charges fee of 0.54%. at the top of the fee range that we consider to be acceptable.
The crude oil ETC works like an ETF in that it tracks an index, the WTI crude oil price index in this case. And we can see that it has fallen around 63% from $9 to $3.6 since January 2020.
To buy this ETC, you need to have an account on a premium investment platform such as Interactive Investor. The free trading platforms such as Freetrade and Trading 212 have too small of an investing universe to offer this kind of investment.
Interactive Investor is the platform that I hold the vast majority of my portfolio in because it is relatively cheap if you have a larger portfolio and it is the best premium platform in my opinion. We'll put a link to it in the description below.
There is no way to invest in oil directly through the free platforms, but there are some extremely close and in many ways better proxies that you can use through those platforms to buy oil.
Number 2, buy oil stocks. With any good investment platform, including the free trade app, you can invest in BP, Royal Dutch Shell, ExxonMobil, and a whole bunch of other oil companies.
Oil companies' share prices tend to move in the same direction as global oil prices, though the movements will not necessarily be to the same scale. While crude oil prices fell 63% year to date, an index of the top oil companies fell 42%. Still a huge drop. By comparison though, the FTSE 100 fell only 23% over the same time period.
The reason an index of oil companies can hold its value better than the actual oil price is because many of the companies in that index are absolute Goliaths of the stock market. Cash-rich mega companies. They are accustomed to the crazy twists and turns in the oil price and are well protected with their gargantuan cash reserves.
They are so stuffed full of cash that they find it easy to adapt to changing market conditions by being able to cut their investment expenditure, and also they are well known for paying out huge dividends. That is the beauty of investing in oil via company proxies. Companies pay dividends and can smooth out returns. Shell has managed to deliver an uninterrupted and uncut stream of dividend payouts since World War II. ExxonMobil haven't missed a dividend in 138 years.
Staying power. We expect they really are too big to fail. The oil companies of today will be the hydrogen and fusion companies of tomorrow.
Those sandal-wearing hippies who harp on about the evils of the oil giants fail to understand that it is these very companies that are investing the most into developing clean energy alternatives. The oil companies won't allow themselves to end up like the fossils that they burn. It won't be Greta Thunberg who turns the world green. It will be BP, Total, Shell, and ExxonMobil.
Number 3. Using an ETF. This is the best way in our opinion. ETFs are diversified, low fee, and most track indexes that can be easily monitored. To invest in oil companies, we'd use an ETF that tracks an index of global oil companies.
The index that we want to track is the MSCI World Energy Index. The ETF I invested in is called the SPDR MSCI World Energy ETF, which has an ongoing charges fee of just 0.3%. This ETF is listed on multiple stock exchanges, but we'll pick the one that's traded on the London Stock Exchange.
Here's the list of holdings within this baby. It's near perfect for what we're trying to achieve, stuffed full of oil supergiants from across the world. In one little neat package, this ETF tracks oil as close as you can get by using stocks rather than tracking the oil price.
It is an accumulating fund, which means that all of the dividends from those legendary dividend-paying companies are collected on your behalf and reinvested into the fund as they arise. The index dividend yield at March 2020 is an incredible 8.28%. No matter the ups and downs of the oil price, you're still getting an amazing boost to your investment off the bat through the dividend. Even if some companies do slash their dividends as a result of this recession, though we expect that many will not. An oil ETC is unlikely to compete with this ETF's growth power that comes from layer upon layer of accumulating dividend payouts, boosting the underlying value from the oil assets.
Again, to buy this ETF, you'll need to use a premium platform like Interactive Investor, linked to in the description below. Portfolio tip. Remember not to put all your eggs in the oil basket. If you're buying ETCs, then we say that commodities shouldn't take up more than 10% of your portfolio. If we include oil stocks and ETFs, we wouldn't put more than 15% of our portfolios in the oil sector because we prefer to diversify across different sectors.
Question of the day: will you be taking advantage of oil's historic lows? Let us know in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.